Hello and welcome to our VC panel, Unicorns 2021. We welcome 4 seasoned VC GPs here because apparently it's not all about buyouts, not even about co-investments. You learned a lot about during the first hours of this Private Equity Summit Munich 2021. Let me welcome my honorable guests. First of all, H.Brandis of Earlybird, maybe the most seasoned VC in Germany in person, I would dare to say, who is still very, very active in the business and very successful. We will learn about that later in this session. Hello, Henrik, welcome.
Hi, thank you for having me.
Yes, we're treasured. S.Cash is next, Project A, originally the Berlin-based VC, second generation Berlin, very successful too. And Sam is with the London office, I guess, relatively new, Sam, and we want to talk with him about VC specs and everything interesting in the current environment. Good morning, Sam.
Super excited to be here. Thanks for hosting this.
Thanks. It's my old friend, Christian. Christian, I think we met in San Francisco maybe 15 years ago or 10 years ago. I don't know. I'm an old man. I don't count. Welcome here. Welcome back. Glad to have you with us for our VC panel.
Thank you. Pleasure to be here.
And as venture capital has US roots, so does L.Seifert with us from HV Capital, the Holzbring Venture Capital Fund. And Laura, and we're really proud to have her with us, is really an entrepreneur turned VC. Hi, Laura.
Hi, thanks for the introduction and great to be here.
Thank you, folks. So why don't we start here? I mean, it's a special year, the second special year in a row, still suffering something from C-19. And as I have been addressing our very first panel, the mid-market buyouts panel this morning, I have the same question for you. What is the one lesson that you took from C-19 that will rest inside your organization? Is there any, if little, adjustment to your processes really based on the C-19 situation? Henrik, if you want to start.
I mean, I think if one thing came apparent to me, then it is that speed and determination make the difference. If you look how different countries have coped with the pandemic, those who've been fast and determined came the best out of it. And I think that was so obvious and it can be managed. And the second thing might be, I'm still amazed what determination, agility can then achieve. And the example I have in the bank is the development of the vaccines in record times. I think this is really, really, truly impressive.
That's true. That's true. And that hopefully lasts for many, many medical treatments that we would be looking at. And also, the medication is next. And hopefully this process will speed up too. Sam, what is your, so to say, C-19 lesson so far?
Yeah, I mean, it's been a very surreal year for everyone, for sure. I mean, an incredibly testing year for most individuals and most organizations. I think maybe to expand the question, we probably have a few learnings from COVID-19. I think first and foremost, and maybe to Hendrik's point, we've seen incredible resiliency within, I guess, the venture capital asset class generally. I think there's been a confluence of factors that have meant that the market for early stage fundraising and financing has been super competitive, from everyone going remote, to there being effective flattening of much of the deal flow and access to founders, to the tons of capital that's poured into the early stages of the market, from multi-stage funds, crossover funds, from people who have effectively been searching for yield. I think from that, kind of our big lessons, I would say, is one, we found a new comfort in connecting with both, our peers, our venture capital peers, founders especially. Before, as part of our process, we required an in-person meeting. That hasn't been possible. I think it's a question that we asked ourselves, back in March of last year. How are we going to replace that? But I think we found comfort in that. We've done a bunch of investments post-COVID. I think we're 8 or 9 investments in. Touch wood that they will go well. And we're starting to see some of our first kind of up rounds, so to speak, so follow-on investments from some of those COVID-19 investments. And then sort of second to that, I think we've seen what it's like to be, how you position your portfolio at the end of a cycle. There's obviously been record amounts of liquidity in the US, probably a bit less so in Europe. And I think when you have a strong late stage portfolio, then hopefully you're in a position to make best use of that. So those have definitely been sort of our 2 learnings, I think.
Great. Yeah, and I think we should be relatively optimistic too. We will talk a little bit about later about, European VCs versus US VCs and the return profiles and perspective. But first, Christian, is there any lesson you take from the C19 situation?
Look, I think obviously we're all privileged to be investing in digital or in that space in general, because that's just accelerated massively, and it's almost cynical to the extent in which, let's say, this has been a positive for the performance of a lot of our companies. So I think we're just lucky to be on the winning side of history in this particular instance. If I think of our internal processes, because I think Sam alluded to that in sort of how we make investments, an interesting learning has been that as European VC, you've always struggled with a slightly imbalanced geographical setup, where typically you'd have one headquarter and then you'd have people in, some of the other hubs, maybe in smaller offices or so on. And so, most of us ran some kind of hybrid model that was, half remote and half physical. You'd get together regularly. And there it's actually been really interesting to see that going fully remote has actually increased productivity massively, because there is only one communication stream that's equal for everybody. And it's actually become easier to hire people in other geographies and say, hey, you're going to be on the same level as everybody who is in, what used to be the main office, because it's just about what time zone you're in. It's an equal playing field, and running a fully remote model for us at least has been actually easier than running a hybrid model. And I think that is a game changer in sort of how you operate as a VC, where you always have to balance being close to entrepreneurs, which in Europe means being in multiple hubs, in multiple geographies, multiple languages, multiple cultures. And at the same time, working as one close-knit team with very short communication path. So I think we'll keep that fully remote model or remote first model. And, there are some tweaks to that. But that's been an interesting learning, just to, add an internal perspective in how to run a VC shop across Europe these days.
Oh, yeah, that's interesting. And I agree, while the world is not Friedman flat, maybe it's really easier through this larger interconnectedness to streamline processes. And Laura, what is your maybe learning from this phase? How have you adjusted over the last 15 months to the situation?
Well, I think that, as Christian said, it was a very challenging year for everyone. I think it has developed differently than what we expected a year ago. When we went into the COVID crisis, I think people were talking about a dry period, very high uncertainty, and that the capital markets would potentially dry out, etc. What we saw was actually the opposite that happened. The investments in Europe have hit a record high. And we also learned that we can work more efficiently remotely. And so actually deal flow has picked up, and the US investors kind of are closer than they were before, maybe because also of the remote setup. So we see a lot more capital coming from the US. And I think that remote work in general has been accepted more widely. Both within VC, like within us as a fund, but also within portfolio companies. And I believe it has been a great opportunity to recruit very high-profile talent. We see that the job market is currently super competitive. And so I would say that overall, our learning was that, I mean, remote work works well, it makes us more efficient, makes the world seem closer across the Atlantic. And it worked well in both investing in companies without meeting them in person, but and also for the portfolio companies because the talent pools are more broad as a result.
Right. So I think that's the positive, yet I think even in the VC area, it would be good to have a nice in-person meeting again, but we're progressing towards that. We see encouraging signs. I think in New York City and so forth. In Zurich, Laura, I saw people sitting outside, and this will happen in Germany, in France too, very closely. So thank you. Henrik, if I may, let's talk a little bit about a certain transaction, because the anathema is that, wow, US VCs is about returns and European VCs were really somewhat longer in the learning curve. Now, let's talk about UiPath, a recent IPO of yours that really, I think, garnered an unbelievable multiple, so a very successful investment. Maybe you can give us a little lesson. What were maybe the three main drivers for the success of this particular transaction?
Yeah, thank you. First of all, I'd like to state that I think UiPath is just another example of successful European VCs investments. So it's not a solitaire. I think it's in good company with other exceptionally successful European companies. And I think it is another representative of the process of democratization of innovation. So since traditional entry barriers for disruptive innovation are fading away, we see a much broader distribution where fundamental innovation is coming from. So innovation has moved out of Silicon Valley. That's what I want to say. It's spread it across the world, and the smart brain actually has become the true bottleneck. So and that smart brain can be located everywhere. Can be in Europe, can be in the US, can be in Texas, but can also be in Bucharest, as we see, Romania. So, and this is, I think it is a fundamentally positive thing. It's especially positive for us European VCs because the dominance of the traditional innovation hubs are losing a little bit of their importance relative to other well-educated region or intelligent region of this world. So education is obviously an important thing. So one lessons learned is we have to find a structure where we cover much broader the relevant small hubs across Europe, across the world. And I mean, Christian was talking about how that can be done. And I mean, who would have thought that out of Bucharest within just 6 years, the globally leading RPA company is emerging. So this is the structure of being spread out, being close to various ecosystems, not just one hub, I think becomes more and more a success factor. Second thing is once one identify such an opportunity, it typically is an adverse bet. I mean, UiPath, I remember when we did the first million in UiPath at that stage for 20%. I remember that we had our, shortly after our annual limited partners meeting, and one of our limited partners took me aside and said, what a great event here and all good, but this UiPath guy, nobody understands it. I'm glad you only put in 1 million. This will be a write-off for sure. So, and it turned out to be the most successful investment we ever did. So it's adverse. So one has to be the courage to do adverse bets. if we always run with the mainstream, it is highly unlikely that we're ending up with an outlier performance. And lastly, I think it is important that we are able to secure early access to capital. So, and as it was important for us to identify UI paths locally, it was, I think, similarly important and material for the further success that they were able to secure a significant investment from Excel and Series B, providing them then an accelerated access to significant amounts of capital. So overall, UiPath has consumed 1.5 billion in venture capital, which is a significant amount. So, and that includes connection to global capital markets, because we as Europeans will never be able to provide that amount of capital.
Right. It's interesting. So there are some lessons, and I really like the idea that Eastern European talent in the mint area is a great way to bring those countries to blossom too. And what I take from you again, and I think you're the third in our round to mention that, is that there's really the VC war for talent is ongoing and is even a bit pushed maybe through the new digital interconnectedness. Sam, if I may ask, VC is about a lot of money, as we learned, if you really bring your company to a successful exit eventually, maybe an IPO. So how is the institutional landscape looking now? You're now, I understand, in the process of fundraising again at Project A. And how does it look like? Are really the large institutional investors in Germany, in Europe, then now accustomed with the VC sub-asset class? Or are there still, is there still hesitance in terms of scale, moving the needle? What is your impression within the current fundraising, maybe?
Yeah, sure. And you correctly point out that, like a lot of venture funds, we're raising our fourth generation of funds at the moment. Also worth pointing out that I'm probably, the most junior when it comes to venture capital on this panel. I've been in the industry for 6-7 years now. So I can only sort of share, I guess, my own experiences and what we've seen at Project A. I think generally, there is a familiarity with the asset class generally with institutionals in Europe. It then becomes a bit of a question as to what familiar means. I think when we make the comparison to US institutionals and maybe how active they've been in investing in venture capital, there's clearly a gap. I think what we've seen over, especially the last 3, 4, 5 years is a steep increase in interest from European institutionals in venture. If we take a look at the history of Project A's funds, so, we were started in 2012. Fund 1 was effectively anchored by German corporates, so Springer and Otto, of which I'm sure many of you know very well. The second fund in 2015, we had EIF come in, which is the European Investment Fund. Again, I'm sure all of you know, it's a quasi-governmental organization that has a pretty significant allocation to European venture. And that for us was kind of the starting point for more institutional conversations to take place. Fund 3, which we closed in 2019, we started seeing an increase in those institutional ones, and maybe interestingly, predominantly from US investors. So we had a few US fund of funds that have, between them 10 to 20 years of experience in investing in the asset class, predominantly in the US. It was clear to us that they wanted to have more exposure to European venture. So that we found interesting. As we look to sort of the fund that we're raising at the moment, which is our fourth fund, we're seeing a pretty strong shift from corporates to what is mainly going to be backed by institutionals, probably a mix of US and Europe. I think interestingly, if you look at European venture on a broad basis over the last 10 years, it's been a pretty good asset class to invest in. The returns have been there. As you look at the asset class today, we've had a bunch of huge success stories. UiPath is obviously one of them, Spotify, Adyen, with a bunch of other companies that are in the pipeline as well. Valuations are not as crazy as they are in the US. I mean, valuations are up significantly, let's not kid ourselves, but kind of on a comparative basis, they still look pretty decent, certainly for kind of the exits that we're seeing, or starting to see, I should say. And the general trend line is that, performance has been strong. We've got a great pipeline of companies that are, likely to go public or be outsized over the next economic cycle. So it's a great time to be invested in the asset class generally. I think like a lot of, investment performance, a lot of investment tends to follow strong performance. So we hope that that's the case here. We do certainly expect there to be more interest from, a broad swathe of European institutionals. And whilst we talk about these things as kind of being beneficial to us, as VCs and to some extent as founders as well, I think kind of the general message is it's probably good for investors as well, whether those are pension holders, whether they're, family offices, fund of funds, etc. I think we've proven over the last decade that there are great returns to be had. So I think the general trend is strong. Kind of maybe to take it back lastly to US institutionals as well. Over the last 5 years, most institutions, most endowments in the US have extended their allocation to venture capital. If you look at the Yale endowment and David Swensen, who's kind of the godfather of asset allocation, they went from 15% in 2016 to I think they're nearly 20+% as of today. So I think that's probably a interesting leading indicator for how a lot of the US institutionals are thinking about it. And I think whilst we don't want to copy the US in every way possible, we hope that that message and those returns will be mirrored over here in Europe.
Yes, that's interesting. 2 observations. Firstly, I think it was the Common Fund organization that really gave the US university endowments a push in terms of their investment policies. Because if you look at the larger Ivy League endowments, they all match David Swensen's and Dean Takahashi's returns when it comes to long-term performance. And secondly, it's interesting you mentioned that it was the 3rd generation of Project A funds that saw a huge number of US fund of funds. And there, the observation is there are a number of VC fund of funds in the US. I mean, Olaf Neubert, Top Cap, but then there are others spun out of successful VC GPs. And we haven't seen that really in Germany, right? We have a number of fund of funds now in Germany that have established themselves over the last 2 decades, but none of those really is in the market for longer than 10 years. My observation, maybe I'm wrong, that really concentrates on venture capital. That's just an interesting observation.
And maybe just lastly on that point, I mean, it's also worth saying that we've seen a bunch of those more experienced US fund of funds that have allocated to venture historically set up in Europe. So not only invest in European managers, but also set up a presence here. Top Tier Capital, who are LPs of ours, They opened an office in London a couple of years ago.
Yes.
Horsley Bridge, who I'm sure most people know as well, they've been present in London for a while. So, I think it's a pattern, it's a trend, and hopefully we'll see more of it from not only US institutionals, but European ones as well.
Yeah, And I think that will happen because we have now one Hamburg-based multi-family office that has done a dedicated, or even the second generation of VC-only fund of funds. Something that will happen. Christian, it's all about digital, virtual. That's why you over at eVentures have written a book, actually, lately, which I really recommend for reading. So what is maybe the lesson from this book that is on German startups and their individual success story? If you summarize, what were your learnings, maybe interesting findings when you guys put together the book? Is there sort of a formula for startup success in Germany?
Well, I wish there was a formula. That'd be great to know. But I think, one of the great privileges of this job is getting to work with entrepreneurs who are always fascinating individuals. And I think, the key lies in the fact that they're all very different. But there are a few things that, we put sort of in the pattern recognition basket, in the sense of that, you see over and over again, and you end up looking for, because they're really important to success. I think on the one side, it's sort of this mix between confidence and paranoia, in the sense that you want guys who are really convinced about what they do, so that, when there is a couple of rough years, when, things aren't maybe as bright as they are right now from a funding perspective, from just overall economic environment, that they don't give up. Because inevitably, most of the very successful companies that we've seen built up over years have had difficult patches. That's just, part of the journey. And I think, so you want to have people who have the confidence to go through that, but at the same time, who are paranoid enough to constantly question themselves whether they're doing things right, whether, things can be improved, or open to learning from others, from their peers, from other entrepreneurs. And that mix, I think, is incredibly important. The other thing that I think we've observed over the years, and I would second Hendrik's point that talent is the gating factor, is that two things are just incredibly important when you build a fast-growing business. One is hiring, and the other one is fundraising. And traditionally in Germany, those have sometimes not been as high on the list as they are in the US. So ability to, ultimately tell an equity story, convince investors about that, and, that way, I don't want to say drive a self-fulfilling prophecy, but at least, put the fuel in the tank that you need to really execute. And at the same time, spending a lot of time on building the best team you can and going through that evolution, because it's teams who win, right? It's not companies, it's teams. And so really drawing on people who have experience and going from, folks who are fast learners to folks who've been there before, and really attracting the best and brightest. Those two things, telling the equity story, hiring well, those are, let's say, structurally massively important elements where I think, the successful founders really excel at those two, beyond, everything that has to do with building a great product and all the things that obviously you need to cover.
Can I add something to what Christian said? Because I couldn't agree more to what he said. I would drive it even one step further. It's not, fundamentally it's teams, but my experience, it is even the CEO founder who really makes a difference. Just an interesting statistic from our portfolio, 100% of our outlying star successes were at the exit still led by the founder CEO, 100%. But on average, we exchange almost 50% of our CEOs over the lifetime of our investment. I think that says everything. So being able to recruit right at the beginning, the right driven founder CEO is the one and only key success factor in my eyes.
That's hugely interesting, Hendrik. Before we move on, maybe one poll question for our audience, which I would like you to answer. Will the exit environment in Europe become more competitive over the next 3 years? What do you think? Yes, no? Please give us your answer, and we will have the stats here towards the end of our panel. Thank you. Laura, given that you were born in the US and you were accustomed with US LPs, US portfolio companies, entrepreneurs, what is maybe the difference? Which traits can we learn from US entrepreneurs and VCs? And is there maybe an edge for us Europeans that we should keep and nurture?
Well, yeah, so I think that something that is a bit different in the US from here is still how entrepreneurship is seen in the society. So I think in the US, it's very much more accepted. It's more of a self-made, is very, very much recognized. And I think that's something that we can improve still in Europe. I think it's very important to give more visibility, that entrepreneurship is also a kind of a job or career path, to teach more about entrepreneurship in schools, for example. Some universities already do that, such as the WHU, the WHU, and they, for example, do a very good job at that. I think it's very important to create visibility and also to make entrepreneurship very attractive. And I think that's also something where political incentives can be set for entrepreneurship to be a attractive career path.
Right.
Thomas, can I add one thing
Christian,
to that?
Yeah, please go ahead.
I wanted to second Laura's point in the sense that I think to some extent, Europe is still a salary culture. Yeah, like especially if you look at countries like Germany. So it's a market where people think in compensation salary. US startup world is an equity culture. Yeah, so it's all about equity, and it's about creating outsized financial returns with equity. That's something that in Germany, for example, is sometimes almost still frowned upon. Yeah, because you have a culture where you try and sort of relate the contribution of somebody to the financial payback. And of course, entrepreneurs sometimes have completely outsized financial paybacks in a relatively short period of time. But you don't see all the guys that, unfortunately are also there that, of course, don't benefit from that because it didn't work out, right? And so this, reward through equity to an entrepreneurial risk is something that I think we just as a society have to fully understand and cherish, because ultimately that creates a lot of jobs, that creates innovation that's incredibly important for us as an economy in Europe as a whole. And, make sure that we look at it with a positive view, in the sense that a lot of good things come from people who have that success, as opposed to, a slightly, more difficult view in the sense of, oh, these guys are making so much money, is that actually justified? Because that doesn't get us to, where we need to be as a society, as an economy. We need sort of the right framework for equity incentives so that, people can actually take risks and will be rewarded if they are successful.
Yeah,
right.
And maybe adding to that, it's also about the failing fast and the appreciation of failure and talking about it, which is different in the US. For example, in the US, companies are sold much faster. So people kind of, when they build up companies and they feel that it's maybe not getting very, very big, then they have a more liquid M&A market to also sell these companies, which is very difficult in Europe. So people stick more to what they've been doing because they are maybe afraid also of repercussions kind of from the society to give up and to say that they failed at something. And I think that we also have to make risk-taking more attractive and more respected. For example, in the US, also the portion that people hold of their wealth in equity is much higher than it is here in Europe.
Yes, it's really the essential thing that father sits down in his chair on a Saturday morning and reads the Wall Street Journal, whereas here he reads Süddeutsche Zeitung or FAZ. And I also see that, there is nothing like Babson College here in Europe, in Germany. You mentioned WHU, HHL apps. They all have entrepreneurial roots and are active in entrepreneurial education, but they always traverse towards the management function and big organizations. And I don't see any Babson College, any Kaufman Foundation grants for entrepreneurs over here yet. So we have the results of our little poll coming in. And so basically, to summarize, it's at about 40% think, yes, the exit environment will improve over the next years. In Europe, we will see probably more IPOs in Amsterdam, maybe even London changes its routes, whereas 60% think, well, maybe not, or maybe not enough. So that's interesting and not too surprising. Do we have any questions from the audience? May I ask the team?
Yes, we have questions.
Okay, go ahead.
How did the COVID-19 experience shifted your VC funds, risk measurements and instruments in terms of portfolio and especially exit controlling?
Anyone did adjustment in the risk management process based on COVID, or any idea on that?
I mean, initially, when I think it remained a little bit unclear how this pandemic will unfold, I think almost everybody tried to steer the portfolio into spending less, keeping capital, being capital efficient, maximizing runways. That's what we've done back in March, April last year. The more I think it became clear that actually our industry is on average rather positively impacted than negatively, because we investing in digital industries, and digital industries are typically remote industries, and remote industries have been benefiting. I think the more we return to classical patterns, and I would say on average, we are rather more bold right now than we used to be before the pandemic.
Yeah, I guess that's a special situation. It's more about the real estate asset management operations active in the area of hotels, for example. So you could be as brilliant as you could be. And that is always the entrepreneurial experience going through the decades. Just stay put, right? It's the just stay put message, I guess. Very good. Henrik, if we stay with you for a second, I mean, given your experience in the German market, I remember, the VCM days when they had these package funds with Apax partners, and you were part of this. I mean, it's already a long story. Very nice. So if you were looking at at two young guys who had a little entrepreneurial experience and are as bold enough in their own right to set up a VC fund, what is the one lesson based from your early years that you would want to provide them with?
I mean, when we got started 24 years back, I had the privilege to meet Dick Kremlich from NEA, one of the founders.
Oh, yeah.
And back then, Dick told me that the education of a VC professional cost on average $50 million. And I didn't want to believe that back then. In hindsight, I must say he was probably right. So that's been said, I think I recommend to young VCs to collect investment experience as long as they can on the cost of other balance sheets. So stay in communities and professional communities where you can collect experience, because the predicament with investing, especially with VC investing, is that opportunities are pretty clear. Risks are often hidden, and one cannot imagine what can go wrong. So developing a good gut feeling, where to be bold and where to shy away, I think it is really, really hard to accelerate that skill development of that skill set. It's at the end of the day, experience helps. I'm totally convinced, and that reflects what Dick said 24 years back. So my mitigation of risk while grabbing opportunities is an art. So this is why VC investing is not a craftsman work. It's really, I think it's more of an art, and it takes time to become really, professional, world class in this art.
That's true. And I remember Dick Kramlich lamenting about his grandfather founding the Safeway of Stuttgart, whatever that is. I have to ask him again. So, and New Enterprise Associates, very good example for a seasoned VCGP. I don't know which generation, 15, 17, 18, they are running now. Really a growth model spread over 3 US cities. Very, very interesting approach. Very active in Europe, even as a quasi fund of funds. So they invest in certain funds too to seed them. So that is really the global network that we have been talking about today. Time is over. You know, I think, would that be enough questions that I have prepared? As always, we only have touched base on half of them. I thank you all, my treasured VCGPs, for being with us today at the Private Equity Summit Munich. Thanks so much. Hope to see you in person Munich at the Bayerischer Hof again on 28th of April 2022. You are invited to the next VC panel, and I'm sure we will see each other there in person, because in the end, not everything is digital, and that's a good thing. So thank you so much. Stay tuned. Hope you find 1 or 2 other panels. Goodbye.
Thank you.
Thanks a lot.
Much
appreciated. Catch you soon. Bye-bye.